And the 2025 year was also significant for private equity and venture capital. So, as private markets, I think, navigated a real turning point. So, after the easy money boom in the late 2010s, and also then the pandemic era surge, the private capital industry faced a much tougher market and much tougher climate in 2022 to 2024. And this was due to high interest rates, fewer exits, and LPs hitting allocation limits. But in 2025, we saw signs of a recovery emerging in deal activity and in exits through, and although fundraising, I think, remained a challenging area. Looking at deal activity, you know, private equity firms were very active in the M&A resurgence, and we saw this from an earlier episode too, where we looked at M&A activity for 2025. But global private equity buyout volumes rebounded strongly, up 40% from what we saw in 2024. And venture capital also saw glimmers of a rebound after a sharp downturn in funding in 2022 and 2023. So VC investment in 2025 stabilized and even rose in areas like artificial intelligence, clean energy, and biotech. So again, all these were long-term secular trends supported the investor interest. The exit environments for private assets also improved. So corporate acquisitions of PE-backed companies picked up as strategics felt confident to buy. So numerous mid-sized tech firms owned by PEs were sold to larger industrial players. Also, IPO window reopened for high quality growth companies. In the US, a handful of IPOs, including a few tech unicorns and PE-backed firms, were seen. So successfully debuting in 2025, which had a very positive knock-on effect. Public market valuations recovered, making it easier for PEs to mark up and exit in investments. Distributions for PE funds to limited partners had been at a decade low in your 2022 to 2023 year. But in 2025, they also ticked up as exit activity increased at the GP level. But still, overall, distributions are, as a percentage of NAV, remained low below the historical norms, meaning that many LPs are still waiting, or were in 2025 still waiting for liquidity. Looking at fundraising and shifting capital sources, looking at the fundraising side, 2024 was another tough year, and 2025 only had a modest improvement. Looking at some Preqin analysis, they bluntly stated it was another tough year for private capital markets, capital fundraising in 2024, with both the numbers of funds closed globally and capital commitment by LPs down on 2023. And this trend extended into at least to the first half of 2025, where LPs, so your pension funds endowments, were constrained by the so-called denominator effect. So public market had fallen in 2022, making their private allocations overweight, and by a backlog of unfunded commitments. Many large LPs simply had no capacity to pledge to new funds until they received some payouts from older investments. So as a result, fewer funds reached their targets, and several PE firms delayed launching their next fund or settled for smaller closes. So the balance of power in fundraising tilted towards very large and established managers who could still secure these commitments, and niche or emerging managers with unique strategies. So while many mid-tier firms struggled, we still had your established fund managers able to raise, and then some emerging managers with unique strategies doing well. And here a bright spot was your alternative sources of capital also stepping in. And here too, if we refer to Preqin, your private wealth investors, so your family offices, have become an important source of new capital. So with high net worth individuals and family offices increasing their allocations to private equity dramatically over the past decade. So 2026 2016 to 2024, the share of private capital coming from wealth channels has rose by over 400%. And that trend continued in 2025. So retail-orientated products like continuation funds, interval funds, and feeder funds allowed affluent individuals to put money into private equity, particularly offsetting the slowdown from traditional institutional LPs. Then additionally, sovereign wealth funds and Middle East investors flush with petrodollar surpluses from earlier high oil prices also played a leading role in backing private equity funds. So in short, while LP liquidity was at a crunch, um, a Bain report called it the real culprit behind lackluster fundraising. As distributions remained at record lows, the industry tapped new pockets of capital to keep funds flowing. And again, it'll be interesting to see how that plays out going forward into 2026, which we'll touch on in one of our next episodes. Looking at the industry outlook and strategy, despite these short-term pains, the medium-term outlook for private capital remains robust. Private equity assets under management were about 5.8 trillion at the end of 2023 and forecasted still to double by 2028, although growing at a slower pace than the previous decade. So returns for exiting PE funds stayed relatively strong through this turmoil, and many funds continues to beat the public market, specifically those that invested in tech early, which gave investors confidence that the asset class still works. Bain's global PE report for 2025 noted that clear evidence of an industry recovery in deal activity and exits, even as GPs face this continuing challenges in areas like fundraising and portfolio company performance. So one emphasis for GPs is of course then liquidity solutions, creating mechanisms like your secondary sale of stakes, your GP-led secondary funds, NAV-based lending grew in use to get some cash back to LPs and relieve some of that pressure. Another focus is adjusting the investment playbook to new environments. So, for example, during the era of cheap money, PE firms often relied heavily on multiple expansions and revenue growth to drive returns, sometimes paying less attention to efficiencies. Now, with higher financing costs and more scrutiny on profits, we saw a few commentators and also from a Bain report observe that private equity investors are learning fast what works and what doesn't. So in creating value, they are increasing the underwriting margin improvement and operational upgrades. So in software companies where simply relying on high revenue growth is not enough anymore. So in essence, operational excellence and actual earning growth, not just financial engineering, has become more important for PE success. And this, of course, is a healthy discipline shift taking place. We've also seen type of deals have rotated. So carve-outs where PE buys divisions carved out of a conglomerate were historically very successful, but recently the average of carve-out performance has lagged, and only your top-tier funds still continuously turn carve-outs into winners. So this also means that GPs must be more selective and have a clear plan to add value in the complex transactions. The day of easy wins is over. On the other hand, growth equity and minority investments gained popularity. So as PE and VC blurred strategies to invest in high growth companies without full buyouts, especially in tech and fintech, of course, technology adoption within PE advanced. So firms are using AI tools, sourcing deals, due diligence, and even portfolio management. And here again, we saw a BCG report highlighting that AI is transforming the M&A playbook across the board. Deal makers are deploying AI and advanced analytics to streamline due diligence processes and identifying targets, which also increases the efficiency and might become a differentiator between firms. Some PE firms that embrace AI for tasks like talent assessment or market analysis in the portfolio companies are seeing benefits. So higher valuations for those using cutting edge tools. Again, this has to transpire into real value, but again, a big focus area. So in summary, from a private equity perspective, looking back at 2025, it showed a split screen really. So front end activity, deals and exits picked up significantly in line with also the public M&A, demonstrating the industry's agility and abundance of opportunities in a transforming economy. But back end fundraising and portfolio management remain areas of caution. So forcing PE leaders to innovate and adapt. The best firms treated 2025 as a time to put strategy front and center. Bain also put it, meaning they are repositioning themselves for a new cycle. So those strategies include doubling down on sectors of conviction. Many fee funds pouring resources into technology, healthcare, energy, transition assets, where they see long-term tailwinds. Also building operational capability, so hiring experts to improve the portfolio company's performance, and nurturing relationships with a broader set of capital providers. So really wooing your sovereign wealth funds, private wealth channels, significant unlocked capital. So as the dust settles, if the global economy continues to show a stable path, PE is poised to be a formidable force in financing growth and innovation as we head into 2026. Thanks again for listening, and looking forward to seeing you on the next episode.